Houston Real Estate Radio starts right now.
Welcome back. You're listening to Houston Real Estate Radio. This week we're talking about something that's come to light recently in the Houston area. There is a neighborhood in particular that we're not naming, but they are trying to make some changes to their amend their declaration of covenants. They want to change it so that the assessment lien will no longer be subordinate to the first mortgage lien. And the reason they're trying to do this, my understanding is that they want to enable the community to collect past due assessments in the event of foreclosures by a bank. Now, I brought Mike Lesmeister. He is with AmeriPro Funding, and I want to get your take on this, Mike, because honestly, the foreclosure crisis is pretty far in the rearview mirror. Would you agree?
No, it is. I mean, foreclosures are down significantly, particularly in the last year, and particularly in the Houston area.
It just seems like it's a little too late, doesn't it?
Yeah, it does. And maybe let's talk a little bit first about what it means to be from a lender's perspective in a superior lien position, and from the homeowners association's perspective. So. Okay. What Brady talked about is being in that first lien position when you foreclose, and let's say that you have somebody who bought a house, and they bought a house for $150,000, okay, and they didn't put any money down. The HOA dues in that community, let's call them $600 a year, not very significant. So, certainly that the house is going to be worth at least as much, in the vast majority of cases, at least as much as the accrued homeowners association dues, the legal costs, court costs, late fees, all the things that we talked about a little bit earlier. So they're assured that they're going to get their money out. And what happens to the lender's perspective, if there's not a lot of equity, if the home buyer has not put a lot of money down, or if there's been a significant amount of depreciation in a community, as you do see in homes that have been plagued by foreclosures, there's not enough equity left when that house is sold at the courthouse steps to cover the amount of money that that is owed to the lender. Right. And so that's why they don't want to take that secondary lien position. So so that's sort of the concern of lenders behind this whole issue, and the advantage that it gives to the homeowners association. So where it does affect potential home buyers now is in the marketability of your house, and we talked about that at the top of the last segment. We know that in most cases you can get conventional financing if you live in one of these communities. We talked about the importance of the 60-day letter, and we can certainly always get a cash sale transaction. Right. Where it really runs into challenges is when we're dealing with FHA financing, because that's the one where I don't frankly know of a lender off the top of my head that will allow FHA financing in any of the neighborhoods that we're talking about here. When we look at that, I mean, that was fine in 2005, 2006, when FHA financing was a small percentage of the loans. Back then, you had a lot of subprime mortgages, a lot of combo loans. Options. Yeah, you had a lot of other options, so it really wasn't a big deal. It only became a much bigger deal when FHA started taking out a much higher percentage of the new loan originations in our country, and we got to the 40%, close to 50% in some areas of all new loans, purchase money loans, were FHA financing, and that's when it started to become a problem, because the homeowners in these communities, if they were at price points where FHA financing, where we talked about $271,000
so a neighborhood that has homes less than $300,000, there are most likely going to be a lot of FHA loans in that neighborhood. Yeah, and this is who it's going to impact.
Correct, and the lower the average price point, the more likely you are to have FHA financing, because FHA financing tends to be more appealing to your first-time home buyer, your borrower who has smaller down payment resources and resources for closing costs. Right. Maybe they don't have superior credit. Maybe their credit is just good, just not outstanding. And that's really the role that FHA has played when subprime went away, was to cover that sort of that second tier of borrowers out there who are not gold plated.
And the issue with that I think we're running into is the lenders. If you do this in a community, then the people buying the houses cannot get an FHA loan. And it's not because the lenders don't want to give them the loan. It's because the lenders can't sell that loan to the secondary market, right?
Right, because back when we had subprime loans, there was a lot more individual investors that were buying mortgage-backed securities and buying mortgages. You had more investors out there. Today, 90+% of all mortgages that are originated are either guaranteed by or sold to the government. Right. So everything that's done today has to conform to those government guidelines. And so because there really is a limited secondary market, a very, very limited secondary market, there's no incentive to take on that risk from a originating lender's perspective.
So the lender might be willing to take on the risk, but then they couldn't sell it in the secondary market. So you're not going to be able to find many lenders, if any. We haven't been able to find any, quite frankly, Mike. You said you haven't been able to find any either. I'm not saying there aren't any out there that'll do it, but I haven't found any, and Mike said he hasn't found any. I mean, they don't want to take that risk. They're stuck with it. The investor doesn't want to buy it. So, like I said earlier in the last segment, we've invited members of the board and also members of the board of director and the management company as well to come on the show and talk about this particular neighborhood and why they're wanting to implement this and the impact it will have. And they're not interested in doing that. So, Mike, just real quickly, do you recommend this? Do you think this is something? I mean, if you lived in that neighborhood, would you want to see this happen?
Well, I think what it comes down to is, and Brady referenced this in the first segment too, is it's balancing out how important it is for the solvency, the future solvency of the homeowners association and their future budgeting, their ability to budget accurately, versus the property rights of a homeowner and the ability of a homeowner to sell their home to a wider range of prospective buyers.
And my view on it is, if the homeowners association could do this and gain that $60,000 that they were potentially going to lose in back fees and whatever from that particular house on that neighbor who's going into foreclosure, that's a great thing. But when you balance that with the fact that now I'm going to have trouble selling my house, now neighborhood values are going to go down. Now buyers, even if they can buy in the neighborhood, it's going to take them a lot longer to close on the property because of these issues. To me, it is not worth it. I don't want to see it happen in any more neighborhoods in Houston, because I know from a realtor perspective, when I take people out to look at these houses and they find out about all these issues, then they start second guessing, and not wanting to be in these neighborhoods. Now, there are some neighborhoods like River Oaks, for example. That is a neighborhood where, one, you couldn't get an FHA loan in there if you wanted to. Okay, right? I mean, the houses are too expensive. It doesn't even make sense to even go there. So they can do it. They can do it, and it's okay. It doesn't affect anybody. But in a community where home prices are $350,000 and lower, it has a huge impact because of the FHA loans that are made in that community. So to me, the value of the community goes down when you make this change, and the ability to sell your house has just gone down. Your buyer pool has gone down. It just has devastating effects on the future of the neighborhood. And to me, $60,000 on one foreclosure house every once in a while is not worth it. And if they had implemented this 3 years ago, it could have possibly been worth it, but even then I don't think so. Even with the massive amount of foreclosures we had, it's not worth sacrificing the future of the neighborhood for it.
And once again, to your point right there, FHA, as we went through the start of the housing recovery, or really when the housing market was deteriorating, and the beginning parts of the recovery, FHA loans played a very large role in helping some of these communities, in helping houses get sold in some of these communities. If you didn't have FHA financing in some of these communities, the values would have deteriorated even further. And you would have had even more potential problems, that you have in any community where you have house values go down, where you have vacant housing, crime obviously moves in, and so forth. So I think it's an important decision, and homeowners need to know the impact of the decision that they're making when they're looking to change the bylaws to implement something like this.
Yeah, and on paper, no one's doing anything wrong. I mean, nobody's doing anything wrong. I mean, this is something that can be implemented, and there are neighborhoods out there who are doing it. But when you look at the impact that it has had on those neighborhoods, like I said, if it's River Oaks, it doesn't have an impact. But on a neighborhood that's mostly FHA loans, it has a huge impact. And, that's what you have to look at, is the effect it's going to have on the neighborhood. And, it's really interesting because I want to make sure people are educated about this, because so many times we get something in the mail from the HOA, for example, who to choose for the board. You don't know any of them. You may or may not vote. It's not a big deal. You need to pay attention to those things. It's very, very important. It's important because for most people, their home is their biggest investment. For the majority of people out there, their home is their biggest investment. And so it is very important to stay on top of what's going on with the homeowners association. It's interesting to me that I had a lot of people who wanted to talk about this, this action, and the effects it's going to have, but I couldn't get anybody from the homeowners association or the management company to comment on it, and that's very disappointing. Because it is something that's you shouldn't take lightly. It's going to have a huge impact on the future of the community. Any last closing thoughts you want to make on it, Mike? What do you think? I mean, to me, I just don't see the value of it.
Yeah, once again, I think the timing of implementing something new right now is very curious. I don't really see that, given the way housing values are going right now, given the recovery, albeit slow in the economy, certainly in the local area, it's relatively strong. I don't understand. I don't see the urgency in implementing something new and something that impactful right now.
And it affects refinancing as well.
Oh, absolutely, because some of those folks, if you have an FHA loan now and you're trying to get a new loan, or maybe you're refinancing from a conventional to an FHA loan because maybe you've taken a hit in equity, or maybe you've had a challenge to your personal financial situation that doesn't enable you to qualify for a conventional loan. You may be out of luck in refinancing.
Yeah, I think that's something homeowners need to think about. That's a big thing, especially for those few who haven't refinanced yet while rates are still low. That's
right. I wish they were lower.
All right, Mike, I appreciate it. We've had Brady Ortigo on. He is a real estate attorney, and we've had his point of view. And now Mac Lesmeister from AmeriPro Funding. Always appreciate getting your point of view as well. We know there are people out there in the market who are happy with their homes, and they may not be looking to sell for 3, 5 years, 8 years from now. But this is still going to impact them. So it's good to get the information out there, and it's just a good reminder too to homeowners to stay involved in your board, know what's going on, keep up with those things, because it is important anytime you make changes to deed restrictions and deed covenants. And one of the things that I've seen is the effects afterwards. Sometimes they don't happen right away, sometimes they're years later, and then it's hard to ever try to go back and make changes again. You've talked them into making a change, they made a change, now you regret it. It's hard to get it fixed, hard to get it undone. So all right, we'll be back in just a moment here on Houston Real Estate Radio. Bye.